Fixed income mutual funds are a popular choice for investors seeking stability, predictable income, and lower risk compared to stock investments. These funds primarily invest in bonds and other fixed income securities, making them ideal for those looking to preserve capital while earning regular interest payments. What are fixed income mutual funds? Fixed income mutual funds invest in debt securities, such as government bonds, corporate bonds, municipal bonds, and mortgage-backed securities. These funds generate returns primarily through interest payments, which are then distributed to investors as dividends. Unlike stocks, which can be volatile, fixed income funds provide more predictable returns and help balance risk in an investment portfolio. Types of fixed income mutual funds. Government bond funds invest in securities issued by governments, such as U.S. Treasury bonds, providing high safety and low risk. Corporate bond funds focus on bonds issued by companies, higher yields but slightly more risk than government bonds. Municipal bond funds invest in bonds issued by state or local governments, often tax-exempt. High-yield bond funds hold lower-rated bonds, junk bonds, that offer higher interest rates but come with increased risk. Mortgage-backed securities funds invest in bonds backed by real estate loans, providing steady cash flow. Inflation-protected bond funds invest in Treasury inflation-protected securities, TIPS, to safeguard against inflation. Why invest in fixed income mutual funds? Steady income. These funds provide consistent interest payments, making them ideal for retirees and conservative investors. Lower volatility. Compared to stocks, fixed income funds offer more stability and less price fluctuation. Diversification. Adding bonds to a portfolio helps balance risk from stock market investments. Capital preservation. While returns may be lower than stocks, these funds protect against major losses. Professional management. Fund managers handle asset selection, reducing the burden on individual investors. Risks of fixed income mutual funds. Interest rate risk. When interest rates rise, bond prices typically fall, impacting fund performance. Credit risk. Corporate and high-yield bonds carry the risk of default, where issuers may fail to make interest payments. Inflation risk. Fixed returns may lose purchasing power over time if inflation rises. Liquidity risk. Some bonds may be harder to sell during market downturns. How to choose the right fixed income fund. Check yield and interest payments. Look for funds with consistent dividend payouts. Assess risk tolerance. Government bonds offer safety, while corporate and high-yield bonds provide higher returns but with more risk. Review expense ratios. Lower fees ensure more of your investment returns go to you. Understand fund duration. Short-term bonds have lower risk but lower yields. Long-term bonds provide higher returns but are more sensitive to interest rate changes. Who should invest in fixed income mutual funds? Fixed income mutual funds are ideal for retirees seeking stable income, conservative investors looking for lower risk options, anyone wanting diversification to balance a stock-heavy portfolio. Fixed income mutual funds offer a reliable way to earn passive income while protecting capital. Whether you're looking for government-backed security, corporate bond yields, or tax-exempt municipal bonds, these funds provide an excellent option for achieving financial stability. However, investors should always consider interest rate trends, credit risks, and fund expenses before making a decision.